What if the fastest path to early retirement isn't found in a high-growth startup, real estate speculation, or the stock market, but in a business so ordinary that most people never give it a second look? Laundromats, self-storage facilities, car washes, service businesses with no glamour and no hype. While others chase explosive growth and unpredictable returns, these overlooked businesses quietly produce consistent cash flow, require minimal innovation, and operate on needs that never disappear. They don't promise excitement, but they offer something far more valuable: stability, control, and time. This audiobook explores why buying a boring business may be one of the most reliable and underestimated paths to financial independence, and how ordinary ownership decisions can lead to extraordinary freedom. Chapter 1: Why Boring Businesses Create Real Wealth. Wealth is often misunderstood. Most people associate it with innovation, rapid growth, and bold risk-taking. But when you strip wealth down to its fundamentals, it becomes something far simpler: reliable cash flow that exceeds your cost of living. This is where boring businesses quietly outperform. They don't chase trends. They don't rely on hype. They don't need constant reinvention. They operate on demand that already exists. The difference between income and speculation. High-growth ventures are built on future expectations. Boring businesses are built on present reality. Instead of betting on what might happen, these businesses monetize what is already happening. People are already washing clothes, storing belongings, and using basic services every day. Ownership simply allows you to capture a portion of that ongoing demand. This shift from speculation to income is foundational for early retirement. Cash flow is the engine of freedom. Early retirement isn't about a single payday. It's about monthly consistency. Boring businesses typically offer predictable revenue, repeat customers, low volatility, straightforward pricing. This creates income you can plan around, not hope for. When income becomes predictable, stress decreases and decision-making improves. Why stability beats speed. Speed feels exciting, but stability compounds. A business that produces modest cash flow every month can outperform a fast-growing venture that reinvests endlessly without distributions. Over time, stable cash flow allows you to pay yourself early, reduce personal risk, reinvest strategically, scale intentionally. Slow, consistent progress often reaches freedom faster than aggressive expansion. Simple operations mean lower risk. Many boring businesses succeed because they're operationally simple. They rely on proven processes, limited product complexity, established customer behavior. Simplicity reduces failure points. Fewer variables mean fewer surprises, and fewer surprises mean more control. Control is what allows owners to step back without the business collapsing. Demand that doesn't need education. Boring businesses don't need to convince customers they have a problem. The need already exists. This eliminates expensive marketing, long sales cycles, constant customer education. Instead of creating demand, you serve it. This dramatically improves efficiency and profitability. Ownership changes everything. Working in a business trades time for money. Owning a business creates leverage. Even modest cash flow becomes powerful when it continues without daily involvement. Ownership converts effort into systems, and systems generate income whether you're present or not. That leverage is the foundation of early retirement. The core insight: boring businesses create wealth not by growing fast, but by working reliably. They prioritize income over image, stability over excitement, and ownership over effort. For those willing to ignore hype and focus on fundamentals, boring businesses offer something rare: a realistic, repeatable path to financial freedom. Chapter 2: Finding the right boring business to buy. Not all boring businesses are equal. Some quietly print cash. Others quietly drain it. The difference isn't in how exciting the business looks. It's in how well it converts everyday demand into consistent, controllable cash flow. This chapter focuses on how to identify the right type of boring business before you ever think about buying one. Start with unavoidable demand. The strongest boring businesses serve needs that are repetitive, non-discretionary, resistant to trends. People can delay luxuries, but they can't avoid basics. Laundromats, self-storage, car washes, waste services, and essential maintenance businesses thrive because demand resets every day. Customers don't need persuasion. They need access. When evaluating a business, ask a simple question. Would people still pay for this during a downturn? If the answer is yes, you're on the right track. Favor simplicity over sophistication. Complexity creates fragility. Boring businesses work because operations are easy to understand. Training requirements are minimal. Systems can be documented and repeated. The goal is not brilliance, it's reliability. If a business requires constant owner presence or specialized knowledge to function, it's harder to scale and harder to step away from. Simplicity is what allows freedom. Look for built-in pricing power. The best boring businesses quietly raise prices over time. They succeed when customers are price insensitive. Switching costs are inconvenient. Location or access matters. A laundromat near apartments or a self-storage facility in a growing area has natural pricing leverage. Small increases spread across many customers create meaningful income growth without extra effort. Predictable pricing power compounds faster than innovation. Evaluate operational overhead. Low overhead protects cash flow. Strong, boring businesses typically have few employees or automation-friendly operations, limited inventory, predictable maintenance costs. When expenses are stable, income becomes dependable. This also reduces stress. Owners don't spend their time managing chaos. They manage systems. Cash flow comes before growth. Many buyers get distracted by growth potential. Growth is optional. Cash flow is not. Before thinking about expansion, ensure the business pays the owner consistently, covers debt comfortably, leaves margin for reinvestment. A boring business that produces reliable cash today is more valuable than a flashy business promising growth tomorrow. Location still matters. Even boring businesses obey geography. Strong locations share traits. Dense populations, limited competition, high convenience value. A mediocre business in a great location often outperforms a great business in a weak one. Location reduces marketing needs and stabilizes demand. Understand the owner's role. Many boring businesses are sold because owners are tired, not because the business is broken. Your job is to determine what the owner actually does day to day, what can be automated or delegated, what systems already exist. The less dependent the business is on the seller, the smoother the transition will be. Red flags to watch for. Even boring businesses can hide problems. Be cautious of declining cash flow without explanation, heavy reliance on a single customer, deferred maintenance, inconsistent financial records. Stability should show up in the numbers. The core insight. The right boring business doesn't impress, it performs. It turns everyday human behavior into predictable income, requires minimal complexity, and allows the owner to step back without sacrificing results. Choosing the right business is not about excitement. It's about control. Chapter 3. Evaluating cash flow like an owner, not a dreamer. Boring businesses succeed or fail on one thing: cash flow. Not revenue, not potential, not promises. If the cash flow isn't real, repeatable, and resilient, the business won't buy you freedom, it will buy you stress. This chapter focuses on how to evaluate cash flow with discipline and clarity long before you commit to a purchase. Cash flow is what pays you. Revenue looks impressive on paper. Cash flow keeps you free. A business can show strong sales and still struggle to pay its owner. What matters is how much money remains after expenses, debt, and maintenance. True cash flow answers one question: how much can this business reliably pay me each month? Anything else is noise. Owner earnings matter more than profit. In small business acquisitions, profit is often misleading. Owner earnings reflect what the business actually produces, what the owner realistically takes home, what a new owner can expect. This includes salary, distributions, and discretionary expenses. Your focus should be on sellers' discretionary earnings, not accounting perfection. Separate reality from adjustments. Sellers often present adjusted numbers. Some adjustments are legitimate. Others are optimistic. Be cautious with one-time add-backs that happen every year. Personal expenses labeled as business anomalies. Revenue growth with no operational explanation. Assume conservative outcomes, not best-case scenarios. Cash flow should hold up under stress. Understand seasonality and cycles. Even boring businesses have patterns. Some months perform better. Some expenses cluster. AI-free, low-drama businesses still require monthly cash flow analysis, awareness of slow periods, reserves for maintenance and repairs. Consistency over a year matters more than spikes in performance. Maintenance is not optional. Ignoring maintenance inflates cash flow temporarily. Smart buyers account for equipment replacement, preventive maintenance, capital reserves. A business that looks profitable only because maintenance was deferred is a liability. Real cash flow survives responsible upkeep. Debt coverage is non-negotiable. If you're financing the acquisition, cash flow must comfortably cover debt. A healthy margin includes loan payments, unexpected expenses, owner compensation. If the business barely covers debt, it owns you, not the other way around. Cash flow should feel boring, not tight. Stress test the numbers. Ask difficult questions. What happens if revenue drops 10%? What if expenses increase unexpectedly? What if you step away for a month? Boring businesses should survive boredom. If small changes create large problems, the business isn't stable enough. Focus on repeatability. Cash flow is strongest when customers return without reminders. Payments are automated. Demand resets naturally. The less persuasion required, the stronger the cash flow. Predictability beats optimization. The core insight: early retirement is funded by cash flow you can trust. Evaluating a boring business requires skepticism, patience, and respect for numbers, not excitement or imagination. When cash flow is real, consistent, and resilient, freedom becomes mathematical, not hopeful. Chapter 4: The acquisition process without the drama. Buying a boring business should feel calm, methodical, and almost uneventful. If the process feels rushed, confusing, or emotionally charged, something is wrong. This chapter walks through the acquisition process with one goal in mind: control. Control over risk. Control over information. Control over your future. Sourcing deals the right way. The best boring businesses are rarely advertised aggressively. They are found through business brokers who specialize in small, cash flow businesses, direct outreach to aging or absentee owners, local networks, and industry-specific listings. Patience matters. Rushing into a deal increases the odds of inheriting someone else's problems. First, filters save time. Before diving deep, apply simple filters. Does the business generate consistent cash flow? Has revenue been stable for several years? Is the industry demand predictable? If these answers aren't clear early, move on. Good boring businesses don't need complicated explanations. Due diligence is about verification, not trust. Due diligence exists to confirm reality. This includes reviewing financial statements and tax returns, bank statements that confirm deposits, expense patterns over time, customer concentration and churn. You're not looking for perfection. You're looking for consistency. Numbers should align across documents. Understand the operations completely. You must know how the business runs before you own it. This means understanding daily workflows, maintenance requirements, vendor relationships, employee roles. If something feels mysterious, it's a risk. Clarity prevents surprises. Financing with margin for error. Leverage can accelerate early retirement, but only when used conservatively. Smart financing includes comfortable debt service coverage, fixed rate terms when possible, reserves for unexpected expenses. If the deal only works under ideal conditions, it doesn't work. Boring businesses should feel financially boring. Negotiation is about structure, not ego. The goal isn't to win the deal. It's to structure it safely. This may involve seller financing, earnouts tied to performance, training and transition periods. Structure reduces risk more effectively than price alone. Transition is part of the deal. Many deals fail after closing, not during it. A smooth transition includes documented processes, introductions to key vendors, temporary seller involvement. The business should not depend on personalities. Systems outlast people. Avoid emotional attachment. Boring businesses reward objectivity. If you feel pressured to close quickly, walk away. If you're emotionally attached to the idea, pause. There will always be another deal. Discipline protects freedom. The core insight. Buying a boring business isn't about excitement. It's about certainty. A calm acquisition process reflects a healthy deal. When every step is grounded in verification and structure, ownership becomes stable from day one. And stability is what allows wealth to grow quietly, predictably, and on your terms. Chapter 5. Financing the deal without sacrificing freedom. How you finance a boring business matters just as much as what you buy. A great business with fragile financing can trap you. A solid business with smart financing can accelerate freedom. This chapter focuses on structuring funding in a way that protects cash flow, minimizes stress, and keeps early retirement within reach. The purpose of financing. Financing is not about maximizing leverage. It's about preserving flexibility. The goal is to acquire income-producing assets while maintaining enough margin to pay yourself consistently, absorb unexpected expenses, reinvest without pressure. If financing removes your breathing room, it defeats the purpose. Seller financing, the quiet advantage. Seller financing is common in boring businesses, and for good reason. When sellers finance part of the deal, they believe in the cash flow. They share risk during transition. Terms are often more flexible than banks. Even partial seller financing improves deal safety. Alignment matters more than interest rates. Bank loans and SBA options. Traditional lenders focus on predictability. Boring businesses often qualify because they offer stable historical revenue, tangible assets, proven demand. SBA-backed loans can extend terms and reduce upfront capital requirements, but they also require discipline. Longer terms reduce monthly pressure, something early retirees value deeply. Avoid overleverage. Leverage magnifies both success and stress. Overleveraged deals. Leave no margin for error. Turn minor issues into emergencies. Force owners back into daily operations. Conservative leverage allows patience. Patience protects lifestyle. Preserve owner cash flow. Your financing structure should allow immediate distributions, reserves for maintenance, room for gradual improvements. If the business cannot pay you early, question the structure. Freedom should start now, not someday. Understand debt like an owner. Debt is not the enemy. Ignorance is. You must know. Monthly obligations. Total interest paid over time. Prepayment penalties. Clarity removes fear. When debt is predictable, it becomes manageable. Use personal guarantees carefully. Many loans require personal guarantees. Before accepting one, ask, is the cash flow strong enough to justify the risk? Are reserves sufficient? Is the downside survivable? Early retirement requires protecting downside, not chasing upside. Keep capital for the unexpected. No business is maintenance-free. Reserve capital for repairs, equipment replacement, temporary revenue dips. Reserves convert problems into inconveniences. The core insight. Smart financing supports freedom. It never threatens it. When debt is conservative, aligned, and supported by real cash flow, boring businesses become powerful wealth engines. The goal isn't aggressive growth. It's sustainable independence. Chapter 6. Running the business without becoming the business. The promise of a boring business isn't just income. It's distance. Distance from daily firefighting. Distance from constant decision-making. Distance from trading time for money. This chapter explains how to operate a boring business so it supports your life instead of consuming it. Systems come before optimization. Before improving anything, stabilize everything. Boring businesses thrive on clear procedures, simple routines, repeatable workflows. Document what happens daily, weekly, and monthly. Systems reduce dependency on memory, personality, or improvisation. Consistency creates freedom. Automate where it actually helps. Automation is not about complexity, it's about reliability. Strong candidates for automation include payments and billing, scheduling and access control, reporting and monitoring. Automation removes friction, not responsibility. The goal is fewer interruptions, not total absence. Hire for reliability, not brilliance. Most boring businesses do not require genius. They require dependability, clear communication, comfort with routine. Hiring for stability reduces turnover and training costs. Low drama is a competitive advantage. Delegate outcomes, not tasks. Micromanagement traps owners. Instead of managing steps, define expected results, quality standards, response thresholds. This allows employees or vendors to operate independently while you maintain oversight. Control outcomes, not time. Use simple metrics to stay informed. You don't need dashboards filled with noise. Track only what matters. Cash flow, utilization rates, maintenance issues, customer complaints. If these remain stable, the business is healthy. Simplicity keeps attention focused. Create distance gradually. Don't disappear on day one. Reduce involvement in stages. Observe and learn. Improve systems. Delegate responsibly. Monitor passively. Each stage confirms the business can function without you. Confidence grows through evidence. Prevent small problems from growing. Boring businesses fail slowly, not suddenly. Watch for deferred maintenance, communication breakdowns, minor cash flow inconsistencies. Early intervention is cheaper than recovery. Presence matters, but it doesn't have to be constant. Protect your time intentionally. Ownership should reclaim time, not absorb it. Define clear check-in schedules, decision thresholds, emergency criteria. Boundaries prevent creep. Freedom requires structure. The core insight. A boring business becomes powerful when it runs without your constant attention. By building systems, delegating responsibly, and monitoring intelligently, ownership shifts from labor to leverage. When the business works quietly in the background, early retirement stops being a theory and becomes your lived reality. Chapter 7. Scaling without complexity or stress. Scaling a boring business doesn't mean turning it into something exciting. In fact, the moment you add unnecessary complexity, you risk breaking what made it work in the first place. The goal of scaling is not expansion for its own sake. It's increasing income while protecting simplicity. This chapter explains how to grow deliberately without sacrificing freedom. Scale only what's already stable. Never scale chaos. Before expanding, confirm. Cash flow is consistent. Operations run without daily oversight. Systems are documented and repeatable. Scaling amplifies whatever already exists. Stability must come first. Replication beats innovation. Boring businesses scale best through replication. Instead of reinventing, duplicate proven locations. Reuse existing processes. Apply the same pricing and maintenance models. Replication reduces risk and training time. Predictability compounds faster than creativity. Expand with cash flow, not pressure. Growth funded by existing cash flow is safer. It allows you to avoid overleverage, maintain operational margin, pause if conditions change. When growth feels optional, decision-making improves. Pressure leads to poor choices. Centralize what makes sense. As you scale, some functions should be centralized. Accounting, vendor management, maintenance, scheduling. Centralization reduces cost and inconsistency. Local operations remain simple. Central systems handle complexity. Protect the owner's role. Scaling should reduce your workload, not increase it. If expansion creates more decisions, meetings, and stress, something is wrong. Your role should evolve toward oversight, capital allocation, strategic review, not daily operations. Beware of false growth. More locations don't always mean more freedom. Avoid growth that marginally improves cash flow, adds disproportionate complexity, increases dependency on you. Growth should meaningfully improve lifestyle or income, not just size. Know when to stop. There is no obligation to scale forever. Many owners reach financial independence with 1 or 2 well-run businesses. Stable cash flow, minimal involvement. More is not always better. Enough is powerful. The core insight. Scaling a boring business is about repeating success, not chasing expansion. When growth preserves simplicity and strengthens cash flow, it accelerates freedom. When it adds stress or complexity, it defeats the purpose. The smartest scaling strategy is the one that lets you stay bored and free. Chapter 8. Automating for time, not ego. Automation in boring businesses is not about appearing sophisticated. It's about reclaiming time. The best automation is often invisible. Quiet systems that reduce friction, prevent mistakes, and remove you from routine decisions. This chapter focuses on how to automate thoughtfully, without over-engineering or losing control. Automate what repeats. If something happens the same way every time, it's a candidate for automation. Common examples include payments and invoicing, access control and scheduling, usage tracking and reporting. Automation works best when rules are clear and exceptions are rare. Repetition creates leverage. Avoid automating chaos. Automation magnifies structure or lack of it. Before automating, ensure the process is stable. Outcomes are predictable. Failure modes are understood. Automating a broken process only makes problems harder to detect. Fix first, then automate. Choose reliability over features. Boring businesses don't need cutting-edge tools. They need proven software, clear support channels, minimal downtime. The simplest tool that works is usually the best one. Complexity increases dependency. Keep humans in the loop. Automation should reduce workload, not remove oversight. Set thresholds where alerts trigger human review. Exceptions pause automation. Customers can reach a person. This preserves trust and prevents silent failures. Automation should assist, not isolate. Measure automation by time saved. The success of automation is not how advanced it looks. It's measured by fewer interruptions, less decision fatigue, reduced operational involvement. If automation doesn't give you time back, it's not working. Automate maintenance and monitoring. Many boring businesses rely on physical assets. Automation helps by scheduling preventive maintenance, tracking usage patterns, alerting issues early. This protects cash flow and extends asset life. Preventive systems reduce emergencies. Avoid vendor lock-in. Overdependence creates vulnerability. Choose systems that export data easily, allow manual override, can be replaced if needed. Control matters more than convenience. The core insight. Automation is a tool for freedom, not image. When applied carefully, it turns routine operations into background processes and gives owners the distance needed to focus on life, not logistics. The best automation keeps the business running quietly, so you don't have to. Chapter 9. Managing risk without killing opportunity. Every business carries risk, even boring ones. The difference is that boring businesses make risk visible, measurable, and manageable. This chapter focuses on identifying threats early and protecting cash flow without becoming overly cautious or paralyzed. Early retirement depends less on avoiding risk entirely and more on controlling downside. Know where risk actually lies. Risk in boring businesses usually comes from a few predictable areas: cash flow interruptions, deferred maintenance, regulatory changes, key person dependency. Most disasters don't appear suddenly. They build quietly. Visibility is protection. Maintain cash reserves intentionally. Reserves turn risk into inconvenience. Strong owners keep operating reserves for slow periods, maintenance reserves for asset replacement, emergency buffers for the unexpected. Cash buys time. Time buys options. Diversify carefully, not randomly. Owning multiple boring businesses can reduce risk, but only when done intentionally. Diversification works when revenue streams are independent. Operational complexity remains manageable. Systems can be shared. Random expansion increases risk. Strategic diversification reduces it. Insure what you cannot control. Insurance exists to protect against low-probability, high-impact events. This includes liability coverage, property and asset protection, business interruption insurance. Insurance should be boring and adequate, not aggressive or minimal. Peace of mind matters. Monitor leading indicators. Lagging indicators show problems after damage is done. Watch leading signals such as declining usage patterns, increased complaints, delayed payments, rising maintenance frequency. Early signals allow small corrections. Reduce single points of failure. Single points of failure create fragility. Identify dependencies such as one key employee, one critical vendor, one dominant customer. Redundancy increases resilience. Boring businesses thrive on backup plans. Avoid lifestyle inflation. Risk increases when personal expenses depend on perfect business performance. Maintain conservative personal budgets. Margin between income and lifestyle. Flexibility during downturns. Freedom requires margin, not maximum extraction. Risk is not the enemy. Avoiding all risk leads to stagnation. Managed risk enables selective growth, strategic acquisitions, opportunity during downturns. The goal is not safety, it's survivability. The core insight: risk doesn't disappear when businesses are boring. It becomes manageable. By focusing on visibility, reserves, redundancy, and restraint, owners protect both income and lifestyle. Early retirement belongs to those who respect risk without fearing it. Chapter 10. Designing your exit and locking in freedom. Early retirement doesn't happen by accident. It's engineered, often years before you actually step away. The mistake many owners make is building a profitable business without a clear exit in mind. This final chapter is about turning steady cash flow into permanent freedom. Define what exit really means to you. An exit is not always a sale. It can be full sale for a lump sum, partial sale with retained cash flow, hiring professional management and stepping back, passing assets to family or partners. Freedom looks different for everyone. Clarity comes first. Build for transferability from day one. A business that depends on you is not an asset. It's a job. Transferable businesses share common traits. documented systems and procedures, automated financial reporting, delegated operations, clear performance metrics. If someone else can run it, someone else will pay for it. Optimize cash flow before valuation. Buyers pay for predictability. Before exiting, stabilize revenue. Reduce unnecessary expenses. Resolve deferred maintenance. Clean up financial statements. Small improvements in stability can multiply valuation. Consistency is more valuable than growth. Choose the right timing. Markets move in cycles. Smart exits consider interest rate environments, industry consolidation trends, local market demand, personal energy and goals. You don't need perfect timing, just favorable conditions. Decide between income and liquidity. Selling converts cash flow into capital. Keeping ownership preserves income. The decision depends on your lifestyle needs, risk tolerance, long-term goals, desire for involvement. Some owners sell one business to fund freedom while keeping others for income. There is no single right answer. Protect the lifestyle after exit. The hardest transition is psychological. Suddenly, your calendar opens. Pressure disappears. Identity shifts. Plan for purpose beyond income. Structure without obligation. Fulfillment beyond productivity. Freedom without direction becomes restlessness. The boring business legacy. Owning boring businesses isn't about playing small. It's about playing smart. While others chase excitement, you quietly build durable income, time sovereignty, optionality, peace of mind. That is real wealth. Final thought. Early retirement isn't flashy. It's calm, predictable, quietly powerful, and it's built one boring, cash-flowing decision at a time. You didn't chase freedom. You designed it.